highs, but still up some almost 1%. You can see the Nasdaq posting a nice gain of 1.25%, led by the likes of Meta, up some over 2%. Some stories out of perhaps some significant layoffs at the company. But, oil overall certainly seems to be driving things. Joe, let me turn to you and just get your read on sort of where we stand in this market, whether you expected we would see this bounce after, of course, that negative action last week.
Well, first of all, it's great to have you here today.
Thank
you. This is
you.
A unique experience. It's a unique experience, Jimmy. When was the last Monday that the market opened higher? We haven't had a Monday opening higher since the end of January. So everything kind of feels a little bit weird, but it's pretty much the same as you described it, David. It's binary. It's can you secure the Strait of Hormuz? We feel as though there's a little bit more confidence in that regard, whether that's valid or not. The marketplace is suggesting that ultimately is the case. And that's somewhat of a punitive environment for investors. So I still believe this is kind of equivalent to a roller coaster. We're kind of experiencing extreme volatility, and we're starting and ending up back in the same place after we're experiencing that volatility. Not the best environment overall. Not very much you can do about it as well. The conversations I'm having with hedge fund managers and portfolio managers, everyone's struggling right now. The volatility is not delivering the alpha generation that maybe you would believe elevated volatility would from past experiences. So let's hope we can build on what we're experiencing here today. I don't think anyone's suggesting you want to sell and move out of the market. It's really about patience and time being your best ally.
Yeah, I would completely agree. I don't think this is a time, Joe, I think you said it well just then, to sell out of the market. Now, you're speaking to hedge funds and institutional investors. I'm speaking.
I believe that we've established where that breaking point for equities is as it relates to oil. So the equity market does not like oil prices above $100, above $105. That seems as though to be the breaking point. It appears as though the equity market is comfortable as it was in 2011, 2012, and 2013, when the average price of oil in each one of those 3 years was $95. The market was comfortable in that environment with oil. So I think if we just basically elevate the range of oil to 85 towards 100, I think we could live in that world. It's when oil spikes well beyond that the markets don't like it.
Steph, I mean, arguably in the early 2010s, the S&P was at 13, 14 times earnings. Maybe not as much was expected out of stocks. But how are you reading what the market's done this week, where it's tried to find a little bit of a foothold? Because you actually have seen some of the laggard groups, try to make a little progress this week.
Yeah, and that's exactly where I want to go. Actually, value outperforming growth today and yesterday. Banks actually finally catching somewhat of a bid. We have to watch that, but they've been a laggard and something that we all have been watching because of the private credit concerns. Energy, oil stocks, some industrials are doing well. So it's more of the cyclical story today and some part of yesterday. And I think, Mike, that's because in the face of uncertainties about war and the timing, the economy is holding up. I mean, you got the Atlanta Fed tracker at 2.7%. Weekly jobless claims last week were really good. I expect them to continue to be very low in the 215 range to 220.
It's the S&P 500 down just over 0.5%. We've been hovering around these levels for a little while coming into today. S&P was up a little more than 1% for the week, kind of low volume drift higher over Monday and Tuesday. You see there WTI crude does have a bid. It's up about $2, above $98 a barrel, had been over 99 a little bit earlier. Took some of the pressure off the equity indexes when we pulled back. So, Joe, we spoke yesterday. You were mentioning that equities have been attempting to kind of loosen the link between every little twitch in crude oil prices. Obviously, it's not going to be a complete dislocation from one to the other. But where do you think we sit? I mean, there's a lot of hope that the stage was set for some kind of a rebound rally in stocks this week.
And for sure, today is a step back in that regard. It continues to be a very frustrating environment. It's interesting because you mentioned yesterday a lot of people wanting the flush. I had a couple of conversations yesterday with a few hedge fund managers who all said the same thing. Like, let's just get this over with.
Yeah, right.
Let's do a V-shaped bottom and let's recover from there. This is far more punitive because what we're really doing right now is we all anticipated this elevated volatility environment coming into 26. And I think we also anticipated a much more muted return environment as well. But when you're in it, I said this to you before, when you're in the midst of it, it feels far more punitive. You're losing trends. You're really losing trends everywhere. You look today, we're down not significantly, but we're down. Okay, where can I hide out? Can I hide out in precious metals? No, they're down 3 and 4%. How about the quality factor? Everyone says own quality in environment.
Dow down almost 400 points. It's less than 1%. Nasdaq and the S&P are both lower as well. As crude oil makes a move here, you almost, Josh, have a two-pronged problem for the market. Not only the move in oil, WTI probably doesn't best represent the jitters in the market just because, Brent today topped 119. And then you have the Fed chair who was more hawkish than not and said inflation's not coming down as much as they, quote, hoped. The odds of a Fed rate hike by June are now higher than the chances for a rate cut. That's the backdrop. That's what you need to know. A hawkish Fed and oil that continues to go up, and stocks as a result are uneasy.
I don't often question the wisdom of the market, but I think in this case, that's crazy. The Fed knows damn well there's nothing it could do with interest rates that would change the price of gasoline at the pump. It's almost an absurd proposition. So I don't believe that to be the case. I understand why the market believes that, just looking at what oil is doing to the inflation numbers, what high gasoline prices are doing. But the knock-on effect to the consumer is actually disinflationary, more so than it is inflationary. It is absolutely causing people to think twice about spending, and I think we're seeing that sentiment everywhere we look. So I don't believe it. The bigger issue for me is the state of the financials. They look absolutely horrible. The 2-year is up the most on the curve right now.
Sure. 385 was what it hit earlier today. We can look at it as Josh is talking. I didn't mean to interrupt, but just to give context to that, yields are definitely up, especially on the short end, on the back of what Powell had to say yesterday and where the Fed seems to be positioning.
Yeah, no, Judge, it's the right interruption because that's really the most important thing. This is the highest we've seen the 2-year since August of 2025. And in the meanwhile, it almost feels like...
I want to see how we come out of the weekend or finish the week here with the triple witching. I'd like to see the market hold ground, not really extend itself below the 200-day moving average that we broke yesterday. The Qs also closed below the 200-day moving average. There's a lot going on with the money flows, and I think that's really what one of the big issues is here. And the war, the Hormuz blockage, it's really moved. It's put a halt on money flows, and I think that's on top of the private credit fears is compounded things right now. Now, I do think that there is some things to hang your hat on. I mean, there's been good earnings. About 73% were beats. Information technology stood out. Energy has stood out. We're overweight energy in our portfolios, and I like that. And really, at the end of the day, it's going to continue to be a stock picker's market. I know that sounds cliche, but there's names that have been just bludgeoned this year that have brought out some opportunity at this point. But there's also names that some downside risk across the market broadly and sectors if things that we're seeing right now with the war and the money flows persist.
Yeah, and energy, the key bright spot in today's market, that sector up about 1.1%. And Steve, I'm curious, so we've talked a lot about geopolitics, a lot about the private credit fears, and then there's also some tightening happening. We were expecting a slew of rate cuts. Now, at least in the market, it's pricing in, potentially even a hike at this point in time, as you have the backdrop of fears about inflation, oil, and what geopolitics could do there. What do you make of that notion, and do you think that the equity market is reacting, in sympathy with that?
First, I want to go back to your first question you asked Bill, where you say that the market's not off, the S&P's not off that much. And that's great if you're an index investor.